Welcome to Creating Wealth with Jason Hartman. During this program, Jason is going to tell you some really exciting things that you probably haven't thought of before and a new slant on investing. Fresh new approaches to America's best investment that will enable you to create more wealth and happiness than you ever thought possible. Jason is a genuine self-made multimillionaire who not only talks the talk, but walks the walk. He's been a successful investor for 20 years and currently owns properties in 11 states and 17 cities. This program will help you follow in Jason's footsteps on the road to financial freedom. You really can do it. And now, here's your host, Jason Hartman, with the complete solution for real estate investors.
Welcome to the Creating Wealth Show. This is Jason Hartman, your host, and this is episode number 255. Thank you so much for joining me today. We've got a great show for you again, and by the way, thank you for all of your recent comments. I got several emails on the last couple of shows, and sounds like you really like them, as I've always heard. So appreciate the feedback and keep it coming. You can always post that on our Facebook page. Just go to facebook.com/jasonhartman.com. We use the website name as our Facebook page name. Or you can just, if you're in Facebook, just type jasonhartman.com. Or you're welcome to email it through our website at jasonhartman.com as well. So thank you so much for the feedback again. Really appreciate it, and makes me always grateful that I can really serve and provide some valuable content and feedback and ideas and inspiration to investors out there, how we can create financial independence and be direct investors and not depend on the Great Wall Street scam, Great Wall Street conspiracy, whatever it is you want to call it. That's what it is in my humble opinion. But hey, let's get into today's show. We're going to talk about a new market that we have been thinking about for many years. Kind of heard some negative feedback, and we were very reluctant. And then we've been talking with a new relationship there. Well, not new, but actually one that was referred to us by a couple of our clients. And forgive me, I don't remember who referred this relationship to me. Otherwise, I'd mention your name on the show. But thank you for that referral, because we've been talking to this particular provider for about 8 months now, and we've been actually working with them, although we haven't had them on the show yet. We have had some investors doing some business in there, and the experiences are good thus far. I think it will work out, and that is Memphis, Tennessee. We will have a market profile on that in just a few moments for you. Couple of thoughts, announcements, articles, current events, etc. First of all, if you have not yet registered, and many of you have, join me in St. Louis, and that is May 18th through the 21st. We'll meet in St. Louis for the Creating Wealth in Today's Economy Bootcamp. That is my most foundational event. I've done that for many groups, many companies over the years, and I've had about 8,000 people or so come through that seminar. It's a one-day program. It will be on Saturday, and then we will have a property tour of St. Louis on Sunday, where we will all get on the bus and tour around, and then on Monday we'll have a St. Robert. You've heard us talk about that under the radar market, St. Robert, Missouri. We will have that tour on Monday, and that's about an hour and a half away from St. Louis. So our local market specialist there is going to have vehicles lined up, so you don't need to rent a car or worry about transportation or anything. We will take care of all of that for you. And, you can come just for St. Louis if you want. So you'd have the boot camp on Saturday, a welcome reception on Friday evening at the hotel, all the information, early bird pricing, registrations at jasonhartman.com under the events section. And then all day Saturday, we'll have the seminar, the Creating Wealth in Today's Economy Bootcamp. That'll be from 9 to 6, I believe, are the hours. It's a long day, but boy, I tell you, we have had great feedback on that. And I kid you not when I say this, by the way. You know those banker boxes, those portable file boxes that are cardboard that you can buy from your local office supply store? I literally have 2 of those boxes full of 8.5 by 11 sheets of paper that are evaluations and testimonials from the Creating Wealth in Today's Economy Bootcamp that I've done over the years for all of the different groups I've done it for. And I tell you, those are extraordinarily positive. There are literally too many to post, but our ratings are 8s, 9s, and 10s out of 10. The comments are incredibly positive. People just love this program. I'm not saying this to pat myself on the back here. I'm saying it because you should be there. So be in St. Louis for that education and the tour of not just one market, St. Louis, but two markets if you want to join us for both. Friday evening, all day Saturday, Sunday, optional on Monday. Okay, so meet me in St. Louis, register at jasonhartman.com. Couple of articles that are pretty interesting, and I tell you folks, I'm a bit of a cynic. I'm skeptical. I'm pretty conservative about stuff most of the time. And I don't want to say that this is a turnaround. I think the economy in many underlying ways is very sick. I think we will have a double dip in terms of bad times, but the second part of that dip, if you look at it like a W, like the letter W, the first part we had was where we had all of these assets being sold off. We had deflation in asset prices, monetary or academic inflation. And then now we've got the banks holding all that money, being tight with it, not lending it out. Very good for us as property investors because it boosts our rental income. Okay, so, when tenants can't buy, they've got to rent, or people can't buy, they've got to rent, not just tenants, but they become tenants because they can't buy because the banks are stingy with the lending. And, that money has not trickled down to the streets yet, has it? No, it hasn't. It's on Wall Street. It's in the possession of the banksters, the criminals on Wall Street, but it has not trickled down to Main Street. And it is trickling down slowly, okay? It's happening, but it's happening somewhat slowly. And what we see here is an incredibly strong rental market because of this. We see rental prices skyrocketing. We see a lot of good things for us as investors. But what is interesting is how positive the news media is becoming. Now, I don't know if they're this positive just because they want to see Obama reelected. Of course, the media definitely skews to the left. I mean, look at folks. No matter what side of the political aisle you're on, objectively, by any objective standard, you must admit that the media virtually all around the world, and I'm a big world traveler. I love to consume media from other parts of the world online, and when I'm in Europe and I read European news media and watch European television, it's a different perspective, but certainly the media skews to the left. Okay, so some of this may be just the Obama recovery syndrome, we'll call it that, but underlying this, there is all this sickening malinvestment, bad governmental policy that is going on that is not good, in my opinion. The economy is becoming sicker actually in so many ways, but in the ways it's getting sicker, it's really going to help us as investors because that sickness, that malinvestment, that bad government policy is only going to do one thing. It's going to cause inflation, it's going to cause more money printing, and more kicking the can down the road, more Keynesianism, less of the Austrian school, less of the Chicago school, and I'm referring to the School of Economics, and more of the Keynesian, big government, bureaucratic school, which, again, I always say it, philosophically, bad deal, but for us as investors, we're not going to change it. We're going to exploit the heck out of it. And that is exactly what we have a duty to do as we are aware of this. So the news media being so positive, here's an article in the Arizona Republic, one of the big newspapers here, and this says, good news for construction jobs. Construction jobs are up 6% as commercial and health sectors grow in Arizona. And it talks about how the construction sector of jobs has added about 6,400 construction jobs in the state of Arizona in the 12 months ending in March. And this is really amazing because what it says here is it talks about all of the different places that are starting to build again. Remodeling, commercial stuff, the power industry. This is, again, more of Obama's bogus green job initiative and so forth. I mean, that's been a complete failure in virtually every way. And, listen, I'll be the first to agree that we need to explore alternative energy. We need to get off oil. We've certainly got enough coal, oil, and natural gas right here in the good old US of A to last us a long, long time if the tree huggers would let us exploit it, but they make it very difficult to do that. If Obama would let us have the Keystone Pipeline, that would be great. Ultimately, our country will succumb to that pressure because, I've said this before, environmentalism is a luxury of a rich society. And we appear to be a rich society, but we're really not. We're just an in-debt society. So, again, the green job stuff, you've heard about the scandals with Solyndra and the other solar companies and just misusing taxpayer dollars and so forth. But it talks about alternative energy providers such as Tempe-based First Solar Inc., They're doing construction. For-profit colleges and universities such as Grand Canyon University. And I was just there last week helping Rich Dad author Sharon Lechter. Remember, she was partners with Robert Kiyosaki and was the founder, along with him, of his company, producing all those Rich Dad books, and she co-authored many of them. And I was helping her with a teen charity that she created called the Thrive Time Challenge. And so I was at Grand Canyon University just last week helping her out with that. And, we had the kids come in, play her Thrive game, and it's kind of like the cash flow game. I mean, it's not like it, but it's the same concept, financial literacy for young adults. And so this positive media, another sign of a turnaround. And here I'm going to give you another one. Sometimes I think I'm on every email list in the world. Well, something I haven't seen for several years now, but my email box is starting to fill up with ads for new homes. Yeah, can you believe it? New home builders advertising in my email box. I'm starting to see them in print publications, in banner ads online. Folks, I don't know about you, but I haven't seen that for 3.5 years, maybe 4.5 years now. So, here's one I'm looking at that I just printed out, La Costa Life. This is La Costa, California, in San Diego County. It says, amenities home buyers want: contemporary creative interiors, modern architecture, unique indoor-outdoor lifestyle living, spacious present-day kitchen to create masterpieces. These are just a few of the amenities that attract the attention of new home buyers, the amenities that make it easier to close a sale. So this is an ad they put out to real estate agents and brokers to get them to come in and bring their buyers to La Costa. And I'm receiving those all the time now from different home builders, in different parts of the country. It is an amazing sign of a fake turnaround. I don't think it's a turnaround. Again, I've already addressed that. But it is a sign that we are at a turning point. And a turning point does not mean a healthy economy in boom times. It just means things are changing. And I think they're changing in a very, very positive way for us as investors. In fact, maybe that's the reason business is booming so much for my company. And I'll give you an example of that. Look at this article, okay? It says, investment and vacation home sales surge in 2011. Washington, D.C., March 29th, 2012. It says sales of investment and vacation homes jumped in 2011. And remember, the news media is always about 3 to 5 months behind in their statistics because they're reporting, most reports are based on closings of transactions, not openings of transactions, okay? So this is why I'm talking to you in April about an article published 2.5 weeks ago, and it says sales of investment and vacation homes jumped in 2011 with the combined market share rising to the highest level since 2005, according to the National Association of Realtors. And look, folks, I will be the first to say that I have my differences, significant differences with NAR, the National Association of Realtors. They're promoting real estate. I mean, heck, that's their job. But, I disagree with them a lot. But look, this I can say, I can see this is actually true because I know it's happening in my own business. And business for me, heck, it has not been this good since 2007, 2008. Business is booming. People are coming out of the woodwork to buy investment properties. No question about it. NAR's 2012 Investment and Vacation Home Buyers Survey, covering existing and new home transactions in 2011, shows investment home sales surged an extraordinary 64.5% to 1.23 million last year from only 749,000 in 2010. And vacation home sales, not investment, but vacation home sales, and don't be the idiot, by the way, that thinks a vacation home is an investment property. It can be in a speculative frenzy type of market. You can make capital gains on those, but again, we are far more careful than that. We may take on speculative stuff when the time is right, but now this is all about cash flow and having properties that must make sense the day you buy them, okay? Anyway, back to the article. Vacation home sales rose 7% to 502,000 in 2011 from 469,000 in 2010. Folks, this is an amazing sign. I mean, people are buying vacation homes. People are buying investment properties like they are going out of style. Don't miss this. Don't be left behind, okay? This is a real important sign. Well, the portion of investment sales jumped to 27% in 2011 from only 17% in 2010. Now, that's the overall market they're talking about, okay? That is an amazing time. And it says NAR Chief Economist Lawrence Yun, we had him on the show. I even got a nasty email. Someone said, Jason, why would you have this tool on your show? That was quite a while back. But hey, folks, I don't agree with all my guests. I want to hear what they have to say. And, sometimes it gets a little heated even with a guest, and I debate them and argue with them about stuff. NAR, just understand they're there to do what they do. They promote real estate. Take everything with a grain of salt. That said, okay? So good old Lawrence Yun said, investors with cash took advantage of market conditions in 2011. Quote, during the past year, investors have been swooping into the market to take advantage of bargain home prices, unquote. He said, quote, rising rental income easily beat cash sitting in banks as an added inducement. In addition, 41% of investment buyers purchased more than one property last year. I'm telling you, if there was ever a time to be buying sensible income property in locations that work, excluding all the bad, ridiculous, silly markets like the Socialist Republic of California, etc., it is now. I mean, this is an amazing time. The lowest rates we've had forever, the demographics of Gen Y, all of these things, the inflationary, irresponsible government spending we have, the fact, you look at what's going on in Europe and around the world, I mean, what a golden opportunity. Here's an interesting email from one of my competitors who will remain nameless because I could do this. Listen, on every show I could get on and bash my competitors and pick apart their offerings, but I only do it occasionally just as an educational thing, okay, and I don't mention names. By the way, someone, and I loved it, Ruben, you're probably listening, sent me an email saying, are you talking about so-and-so and so-and-so? And I wrote back and said, I'll let you draw your own conclusions. So I'm not going to mention names, but I will mention this. This property is a property in Indianapolis, a market we've done business in for many years, $74,500, and it's a 3-bedroom, 1.5-bath property. And listen to what this says, okay? Cash purchase, you would have $542 net monthly return, 9% cash on cash. If you finance it, you would have $218 every month. Now, of course, that depends how you finance it, but on the financing they're promoting, 12% cash on cash return. Now, here's the problem. Couple problems. First of all, this property was built back in 1920. And look, I've come around, okay? In St. Louis, I've come around. We are doing older properties now, and I'm okay with that. But if it's going to be old, and it's going to have the potential for problems older properties have, I must see a much higher return on my investment than is being offered here. Because you could buy one of our properties in Indianapolis, and you could do far better than this, and that property would only probably be 6, 7, maybe 10, 12 years old. Now, this property built in 1920, and I'm looking at the picture, folks. It's old. It's old looking. It looks like a high-maintenance old property. And this property is $42 per square foot. Folks, I can find you properties that are 12 years old in Indianapolis in better neighborhoods for $42 or less per square foot. They're just picking the low-hanging fruit here. I mean, this is too easy. Now, I looked up the property, and I looked at the Trulia website, and here I'm looking at the comps for that property. And this one's $42 per square foot, and all of the comps in the top 10 comparables, or the top 12 comparables, or even the top 20, there are only 2 that are more expensive per square foot than this property. And one of them was built in 1970. You could buy a 1983 property for less per square foot than this one. I mean, this is crazy. Folks, you really got to do your due diligence, okay? And it is amazing to see how successful some of my competitors are and how junky some of their offerings are. Last news item here. This is a Reuters news story, okay, entitled Wall Street Sees Big Profits in Renting Out Foreclosed Homes. Now, we've talked about this on prior episodes, and, you've certainly read about it in the media. And some investors have viewed this with trepidation, and they think this is, oh, gosh, this is bad. Wall Street is going to be my competitor. They're finally getting into the real estate business. Warren Buffett had that quote. He said he'd buy a couple million single-family homes if he could figure out how to manage them. And, the problem is they can't figure out how to manage them. And they've got all of these other problems that come up. But hey, if they do, so what? Okay, remember, income property being a multidimensional asset class, here's what you've got to remember. Say, for example, hedge funds, Wall Street folks, they come in and they buy hundreds of thousands of single-family homes around the country. And they manage them well. And they are a good landlord, and they are good at it. Well, what is that going to do? What effect does that have on the real estate market? Well, it soaks up the shadow inventory. So that means prices solidify. So you see prices either solidifying and holding their ground or going up. Good news for us as investors. What if they come in and they're a really aggressive landlord? Big landlords tend to, whether it's they don't do it intentionally or illegally necessarily, but they tend to price fix. That's the effect it has on the market. That's why we have a Department of Justice who won't allow monopolies. When you see large companies like Microsoft trying to buy QuickBooks or whatever these mergers are, we see the government interfering, saying no monopolies. It's bad for consumers because they won't have choice. Well, hey, if Wall Street comes in and they're a great manager of properties, which I say they won't be, they'll mess it all up. And I'm going to touch on that here in a moment. But say they do it great. Say they do a wonderful job. Well, they're going to increase rental prices, and they're going to soak up shadow inventory, so they're going to increase for sale prices and rental prices. Good news for us as investors, right? But guess what? They've got some other problems, and here they are. So first of all, pilot project, it says in the article. The Federal Housing Finance Agency, which regulates Fannie Mae and Freddie Mac, expects it will receive a considerable number of bids in April for the initial round of 2,500 Fannie Mae, Fannie-owned homes in cities like Atlanta, Chicago, Los Angeles, and Phoenix. Guess what? We're part of that deal in Phoenix. We have access to that inventory. And I've talked again about how difficult it's been to do business in the Phoenix market. It really has been difficult. And on just the last episode, number 254, I talked about that. But out of those four markets they mentioned, I love Atlanta. Phoenix is good if you can get decent inventory. A lot of people, by the way, have been hitting us up asking if they could sell properties in the greater Chicago area through our network. I have categorically turned them down every time. And I know a few of you listen to the show because you mentioned the show in your emails to me and our conversations. And I appreciate that you like the Chicagoland area. Again, I always reserve the right to change my mind and be open as times change, but generally speaking, I think the prices there are a little bit higher. And I think that the political environment is landlord unfriendly. That's Obama town, okay? Anywhere where you have big overreaching government, you have tenant-friendly markets rather than landlord-friendly markets. So just a little commentary there. And I'm still trying to make California work. I'm constantly looking at the Inland Empire, and we still haven't made that work. But again, California being not a very landlord-friendly market by any means, at least it's not, in the Bay Area or in Santa Monica area, or LA where it's really unfriendly. But some of you just love California, and I can't figure out why. I read an interesting article, by the way. I put it on my Facebook page. 16 reasons to move away from California. Look that up. It's pretty ugly, really, what's going on in California in so many ways. I'm glad I moved. I will say that. But here's the other thing it's saying. It says in the article here, back to that, we have a shortage of rental housing already, and I think it's a win-win situation, says Kenneth Rosen, chairman of Rosen Consulting Group, which advises on urban planning and real estate management. And he says, I don't think the money to do this is the problem, says Rosen. It's the execution. And you know what? I think that's where the big investors are going to fail, on the execution. Because you've heard me talk about the concept of embracing the fragmentation, right? Embrace the fragmentation. That's why it's hard for the biggies to come into our market. But look at what else this article says. It talks about how it could be a PR nightmare, public relations nightmare. And here's what it says exactly. See, there's all these different circumstances and pressures, even if the real estate deals are great, that are weighing on the big fund type investors, the institutional investors. So PR nightmare. Some hedge fund managers say they're staying out of the market largely for fear of getting vilified as being a bad landlord if it comes time to evict a tenant. One manager said he did not want to be identified, but he said that there's a lot of money to be made from investing in foreclosed properties, but it's a potential PR nightmare. So again, a whole nother set of concerns that we don't have as individual investors. Okay, hey, I thought I'd mention one more thing. I have been interviewing for my Speaking Wealth show a whole bunch of podcasters lately, and I just want to thank all of you so much for listening to my show, for telling your friends about my show, and supporting the show. And we're on episode number 255 now. I can't wait till we get to episode number 1125, okay, or whatever the number is, because I just have a lot of fun doing this show. I love getting you clients on the show. So if any more of you want to be on the show, please go to jasonhartman.com, fill out the contact us form, and say you're interested in coming on the show. We'd love to have you on to share your experience with your investment properties and how it's working for you and any tips and ideas you have. You can just be on for a couple of minutes. You can be on for the full segment depending on what you have to say. But we always love to have your participation. But one of the things I'm doing is I have to be honest. I was doing my taxes, and I couldn't believe how much money we have made, how much business we have produced from our different podcasts. I run 15 different podcast shows, and my different companies are involved in those, and I just love doing it. And if any of you have ever had an interest in podcasting, I am working on a product to teach people how to podcast and how to develop relationships out of their podcast and do all the things that I've been doing for so many years, because I, frankly, looking back, cannot believe how well it's actually worked. So a lot of you have asked me about that, and I just thought I'd mention it. It doesn't have to do anything directly with income property investing, but more to come on that in the future. I have talked about on some of our business shows that we used to do, because we used to do maybe, 100 episodes or so, 70 episodes or so. We were doing more and more business shows of how you can do internet marketing businesses, home-based businesses, things like that, because so many of you real estate investors, you kept asking, gosh, the economy is so bad. I want to take advantage of the opportunities to invest in income property now, but I got laid off from my job. How can I produce income? So we started doing some shows on income opportunities and so forth. Nothing sketchy or scammy or hokey, just real stuff, real businesses, real ways to expand your existing business. And, I talked back there in those old days about a year ago and before about the PME concept, building your personal media empire. And the first book I ever published was called Become the Brand of Choice back in 1999. And it was all about relationship marketing and personal branding. And so, I just wanted to say, first of all, thank you so much for supporting the show. Thank you for spreading the word about the show, not just this show, my other shows, but also if you have an interest in that, if you have an interest in using podcasting and personal branding and internet marketing to expand your business, keep listening, because I'll tell you about my product based on that I'm coming out with and my little course on it. I've had a lot of fun working on this lately, and so more to come on that. Okay, hey, let's talk about our market profile. We've got our guest, our local market specialist from Memphis, and we will be right back with that in just a moment here, but be sure to register for our St. Louis Creating Wealth Bootcamp and tour of St. Louis and St. Robert. It's coming up in just a few weeks, so I want to see you there, and we will be right back with our Memphis profile here in just a moment.
What's great about the shows you'll find on jasonhartman.com is that if you want to learn about investing in and managing income properties for college students, there's a show for that. If you want to learn how to get noticed online and in social media, there's a show for that. If you want to know how to save on life's largest expense, there's a show for that. And if you'd like to know about America's crime of the century, there's even a show for that. Yep, there's a show for just about anything. Only from jasonhartman.com. Or type in Jason Hartman in the iTunes store.
Hey, I wanted to talk to you about a market we've been rather hesitant to go into, and that is Memphis, Tennessee. We were actually urged by one of our clients to look at this provider and this local market specialist and this market. After much delay and thinking about it, we finally decided that I think we have a very good partner there, and we're glad to talk to you about Memphis, a market we've considered for many years, but we have really never wanted to open until just recently. Welcome. How are you?
I'm doing great, Jason. Glad to be here and excited to talk with you and your clients about what's going on here in Memphis and why it's just a gold mine for investing for cash flow.
Fantastic. Well, the cash flow is very good, and I'm looking at 14 different properties of yours on our website now at jasonhartman.com. A couple of them are in escrow, a couple of them sold under contract, but several are still for sale. And first of all, let's kind of go down the funnel if we can. Let's take the 30,000-foot view. And Memphis is an area that I would best describe as spotty. Is that a fair characterization?
I would say no. I was probably like you, Jason. I came out of the corporate world with Wells Fargo after 12 years, and Wells Fargo brought me to Memphis. So I didn't know anything about this market. I now have been here for over 10 years. I've been full-time in real estate for 7 years. And we've probably have been part of over 1,500 real estate transactions during that time, me and my team, and probably 90% of those transactions are single-family residences. But Memphis is a very defined market economy, plain and simple. We are the transportation hub, the distribution hub of the United States.
Well, of course, that's where Federal Express started, so no question about that. And when I said spotty, let me just clarify what I meant by that, is that it's always important to invest in the right marketplace, but also the right micro markets or sub-markets within that marketplace. Yeah. And what I meant when I said spotty is that you could easily make I think Memphis is more sensitive to the spottiness factor than some other cities. It's always important, but it seems like in Memphis you could really make mistakes if you don't know what you're doing.
Yeah, Jason, I'm with you now. Yes, Memphis, and I'm sure every major metropolitan city in our country, you have your good areas and bad areas, and you're correct. I could definitely share with you many horror stories that come our way on a weekly basis from investors who bought here blindly, without a team of people, without a team of professionals, and they found us and they're trying to bail out of an area that we don't even go into. I wouldn't even know the name of the streets, and usually that is what happens. They tell me the name of the street, and when I recognize it, I know they're probably in trouble. But bottom line, we buy and target 60% of the city of Memphis. 40% we just don't go into. We only want to buy properties where we know the rents, we know the tenants that are attracted to those neighborhoods, and that we're comfortable managing because, as you know, Jason, we provide a turnkey investment opportunity for our investors, and so after the sale, we are there to manage the property, and we want to make sure we're in safe neighborhoods, and so you are right that we do have a spotty market when it comes to that description you're discussing.
So let's go back, now that we agree on the definition of spottiness, that's good. Let's go back and the distribution hub of the United States, what else would attract an investor to Memphis over, say, markets in Texas? By the way, and I must mention, I believe in your state constitution, they believe it's unconstitutional to have state income taxes. So I like that. I think it actually says it right in there.
I think we're one of 8 states in the country. Yes, we have no state income tax, so that's good.
That's very attractive. And the reason I mention that, and get off on a slight tangent here for just a moment, is that in Texas you don't have state income tax, but the property taxes are much higher.
Double than Memphis, yes.
Right. So maybe you can address how does Memphis do that? Where are they getting their revenue from if they don't have high property taxes because they're low there and no state income tax? Great combination.
Well, I will have to disclose to you that actually Memphis has the highest real estate taxes in the state of Tennessee as far as, all the counties, and we actually get a black eye, but then people that are enclosed in, their lifelong residences of Tennessee or Memphis, they don't know what's going on in other parts of the country like you and I, because we work on a more international, global basis. So we know what real estate taxes run in the Northeast and Texas, and so, I can definitely appreciate what we do have. Now, we do have one of the highest sales taxes in the country. It's 9.25% sales tax. And, so I suppose
that's not that
where
bad, though.
they make it up.
Yeah, sales taxes are not that far off from that anywhere else, really. But anyway, in terms of the attractiveness of Memphis, that's really what I wanted to talk about. Talk about those things.
Jason, here, let me give you a very simple formula for you and your clients to understand. And because with this formula, you can analyze any deal anywhere. Doesn't matter if it's a $10 million commercial deal or if it's a $50,000 house. But if you just look at your acquisition cost, what are you paying for the property, and what is your rent, and do the division on a monthly basis, and you will quickly see that so let me give a quick example. If you had a $100,000 house and you're getting $1,000 a month, that's 1%. So in a year's time, you're getting 12% gross revenue off your investment. When I got into real estate here in Memphis in 04, 05, 06, we were, again, working with investors nationwide, and we were able to get anywhere from that 1 to maybe 1.25%. And we were high-fiving. We thought, and the cash flow was positive at that time. And our market wasn't really taking off or enjoying all the appreciation that the coastal markets, the West Coast where you're at, the Northeast, the Arizona, we're seeing all these headlines and we're just sort of huddling along at 3%. But what we did, and the reason we're still around, is we invested in the pure fundamentals of real estate, and that's cash flow.
Absolutely. Couldn't agree more with you. The cyclical markets are the high-risk markets for gamblers. Yes. The linear cash flow markets like Memphis and like the other markets we recommend on jasonhartman.com are the markets that just work. They make sense year in and year out. You do it over time. You don't have to watch everything too closely. You don't have to stress out about it. Income property is about just that. Income.
Well, and Jason, what's exciting, let me finish that formula today. What our investors are enjoying is anywhere from 1.5, 1.7, even in some rare instances, maybe approaching 2% a month on that simple formula. So instead of, that $100,000 acquisition getting $1,000 a month, our investors are getting a minimum of $1,500 and probably really pushing $1,750 and sometimes more than that. Now
that's hard to beat. I mean,
right.
when you're looking at an RV ratio of 1.5 to 1.7%, I mean, the cash on cash return there is just phenomenal. RV means rent to value ratio.
Right. But yeah, Jason, so our investors are just enjoying valuations, cash-on-cash returns with some of our exclusive financing programs that are just almost too hard to believe. Of course, we're very cautious. Again, that's another, I think, fundamental has made our investors very successful, that we make sure that we try to calculate worst-case scenario. We're using very conservative numbers, making sure we're assuming vacancy, we're assuming maintenance, we're assuming management. Obviously, we know exactly what the property taxes are and the insurance costs, and you boil it all down, and what separates Memphis from the other markets. And Jason, I got to tell you, I've been all over the place. I've been West Coast, East Coast, all around the state of Florida. I was in Vancouver, Canada. And I will tell you, and I know you represent other markets, and there are some trade-offs, but there is not a market that I have found that touches Memphis. Bottom line, plain and simple.
Yeah. Our best cash flow markets right now are St. Louis, Indianapolis, and Memphis. And I think Memphis might actually beat even St. Louis, which is pretty darn good. And tell us more. I mean, let's talk cash flow a little bit and talk about the characteristics of sort of your ideal property, your typical deal that you want to bring to our investors?
That's a great question, Jason. It's actually very easy to answer. Our average, I call it our workhorse. I mean, that is our B grade, middle of the road property, which is a 3-bedroom, 2-bath, single level brick home that is probably going to be right in the range of 1,500 square feet. Most of our homes are located on about a quarter of an acre lot, very typical. And our investors are going to be in that property fully renovated. And our definition of fully renovated, we don't cut corners. I mean, we won't, obviously, one of the sins of being a real estate investor is putting too much money when it's not needed. So we definitely take pride in cost cutting, but we want that property to be in like new condition. We do want to achieve the high level rents in the market. But that average home is going to be $65,000, and that house is going to rent for $1,000 a month.
That's almost 2% rent to value ratio or RV ratio. Unbelievable. Right.
So that is our average home. Obviously, we have some homes that are going to be below that, and we'll have some higher grade homes, nicer, newer 4-bedroom, even 5-bedroom homes. So we just, as you know, every investor has their own appetite, their own goals of what they're trying to achieve, and we try to work with each individual investor on helping them meet those goals.
Now that we talked about kind of your target property or what you call your workhorse property, let me just take the listeners through a specific property we have available right now. Now, of course, by the time you hear this show, it may not be available because things are moving so quickly nowadays, which is, a good problem to have for sure.
Sure.
But this one, it's basically, here's how it looks. It's built in 1961. It's a 3-bedroom, 2-bath. It's brick. It's 1,324 square feet, $51,900. Only, less than the cost of your typical car in Scottsdale, Arizona, or Southern California for sure. In this property, the projections look like this: $800 per month rent. By the way, your total cash needed to buy this is about $11,300. You're buying it for only $39 per square foot. And when you look down here, your cash flow is projected at $254 per month, which gives you a capitalization rate or cap rate. And as my listeners know, I'm not super fond of the cap rate metric because it doesn't tell enough of the story. But a lot of our clients who are used to investing in commercial real estate but have reformed themselves to some extent to see how single families are usually a much better deal, or at least apartments are a much better deal than office or retail property, which are highly complicated, highly risky, is 11.2% cap rate. And cash on cash return here, folks, this is unbelievable. A whopping 27% annually. As a reminder, cash on cash means if the value goes to zero, but you just maintain the income and the expenses where we project them, you will still get basically a bond, an annuity, an income stream of 27% annually, and the overall return on investment of 46%. Wow. You cannot beat that. That is unbelievable.
Yes, it is, Jason. And as you see, the price points that we have, again, our average transaction is right there in the $60,000-$65,000 range. And so it's a good, safe place to be. And another great characteristic of the Memphis market that I would like to mention is our renter population. Even in the 04, 05, 06 boom days, Memphis had double the percentage of renters than the national average, and so we are and have been a big renter city, and so we have very little problems renting houses, which obviously makes this thing go. If you didn't have the rental demand, it'd be very difficult.
Well, I have to tell you something, and I have no idea if you've read this book or not, but Neil Ferguson, spelled Niall, a lot of people say Nile, but it's Neil. Neil Ferguson has written many books. One of them is called The Ascent of Money, A Financial History of the World. And it's fascinating because he starts that book off talking about, of all places, Memphis.
I've not read that book. I'll have to get it.
Yeah, and he talks about how in Memphis, and this is kind of a funny thing when you talk about renter population being so big, but he talks about how in Memphis, the foreclosure rate has been so high even before the financial crisis because people would just walk away from their houses. What are they, like, just more irresponsible in Memphis than other places? Now, listen, if you can landlord through that, that's actually a great opportunity. Most people would not think counterintuitively to know that that really makes your opportunity better as an investor, because people that have been foreclosed on make great long-term stable tenants many times.
Yes, they do. Yes.
But what would you say to that, Neil Ferguson's comment on the foreclosure rate?
If he had done a little more research, what he would have found that would lead to that statement, Jason, and I learned this being in banking for since I've gotten out of college, but since the government started keeping bankruptcy statistics, which was 1991, Memphis has had the highest number of bankruptcies per capita than any metropolitan city in the country. To go back from that, you have to also understand that the attorney that wrote into law legislation for the Chapter 13 bankruptcy was here in Memphis. So the bankers, we joke that the Chapter 13 bankruptcy was invented in Memphis.
That's interesting. Let me tell you what Neil Ferguson says, because I just pulled up that part of the book. It says, Memphis, Tennessee is famous for blue suede shoes, barbecues, and bankruptcies.
Oh, okay.
If you want to understand today's bankers, and he goes on to talk about the general credit problem all over the world, but he says, most borrowers who run into difficulty in Memphis can escape, and these are the borrowers who had mortgages, can escape or at least reduce their debts, stigma-free and physically unharmed. And he just talks about how he visited Memphis the first time in the early summer of 2007, and he was fascinated by the ubiquity and proximity of both easy credit and easy bankruptcy. So, I mean, Memphis is like renter city, isn't it?
Yes, it is. It can be sad, but obviously we can
exploit the heck out of it. Yeah.
Right, we're in the market to take advantage of that.
That is amazing and very interesting. Let me take a brief pause. We'll be back in just a minute.
Jason provides an extremely unique service, Deal Evaluator. Are you interested in a property outside of our network? Need a second opinion? No problem. Let our experts evaluate the deal. Find out more about it at jasonhartman.com.
Well, tell us more about where do the tenants work? What is the sort of tenant profile in maybe your workhorse properties that you mentioned? What can we learn about tenants there, other than the fact that they file bankruptcy? And, by the way, someone who files bankruptcy is so much better as a credit risk usually because they can't file it again for 7 or 10 years, right?
That's right. And usually people are going to pay for their shelter needs, their rent or mortgage payment before they'll pay anything else. And we are seeing more and more renters, Jason, that are they actually have perfect credit, and the only ding is a foreclosure on their mortgage, and they are, obviously just the best tenant that we have because they don't want to go into an apartment community. They've spent the last 15, 20 plus years of their life having their own backyard, their own private space, and they don't want to go and have someone above them and someone below them, and they got to go through whatever you have to live in an apartment community. So it's just been a great time to be in real estate. Who is our tenant? Well, first of all, we just sort of talked about it. Our tenant, for the most part, Jason, they do not qualify to buy a house, but even, you and I can jokingly say that even good people can't qualify. The lending is so tight, but the house that we're renting for $1,000 a month, those consumers could, if they had the credit worthiness to buy the house, their principal, interest, taxes, insurance is probably going to be like $400 a month. So I'm a great guy, but I'm not that good that somebody want to pay me $1,000 versus $400. So keep that in mind. But our tenants are middle-aged, working class consumers. Again, we are the distribution hub of the country. We have over 30,000 employees at FedEx. We have over 250,000 workers that are directly or indirectly tied to the Memphis International Airport. And we have all Class 5 railways that comes through Memphis. Chicago, New Orleans are the only other two U.S. markets that can make that same statement.
Tell the listeners what Class 5 means.
There's only 5 Class 1 railways in the United States, and all 5 of those come through Chicago, Memphis, and New Orleans. And probably we've exceeded over $1 billion in investment by those 5 railroad companies in the last 5 years. As you know, Warren Buffett, I guess it was 3 years ago, bought BNSF. And I don't know all the other ones off the top of my head, but we have more trucking companies in Memphis than any other city. The Mississippi River, which is the largest river in the U.S., we have the 5th busiest inland port. And then we have the Memphis Airport, which for the last 15 years, Jason, has been number 1 in the world, which is an amazing statistic, the number 1 airport in the world in cargo shipments. But Hong Kong in February of last year actually finally inched us out, so we're technically number 2. Singapore is number 3. Some interesting statistics I like to share with people: Disney. Every Disney product in the world is distributed through Memphis. If you go to a Disney amusement park, if you go to the Disney store in the mall, that product came through Memphis. Nike has 4 distribution centers with a total of over 3 million square feet in space. And I can just go on and on and on. And plain and simple, the reason for that is our geographic location. We're somewhat center to much of the population. If you look at the map, you're like, well, you're not really center, but we're actually based on where the population is. And FedEx can actually get to over 80% of the population in our country on a 2-hour flight. And that's what has grown FedEx from 1972, fast forward today, 40 years later, to one of the, not just our country, but probably arguably one of the world's, economic power trains. I mean, they're just out of control. So that's Memphis, and so obviously we just have tens of thousands of people that work in that distribution network. And second would be biomedical. We have a huge presence of biomedical companies here, and for Jason, those people that don't know what that is, it's artificial body parts. And which, as with the baby boomers coming of age, that is becoming, those companies are very profitable. Some of those companies locate here just because of FedEx. That way they can get, we can deliver a package here in Memphis up to 11 o'clock at night, and have it guaranteed delivery by 10 o'clock tomorrow morning, pretty much anywhere in the United States.
That's amazing. Handy to have FedEx as your neighbor.
Yeah, so that's who our, I would say 80% of our tenants work in some capacity of the that distribution network.
And you have duplexes? Do you have fourplexes, triplexes, any multifamily larger deals?
We don't, Jason, and we do get asked that a lot, especially West Coast investors, but I got to be honest with you, Memphis, and I know this from having painfully built probably over $10 million in real estate, they don't really allow like a duplex or triplex or quadplex. They will not issue a building permit for a product like that any longer. And they stopped that probably back in the 80s. And so especially if you have a triplex or a fourplex in Memphis, it's probably going to be something that was built about 80, 90, 100 years ago. It's going to be in part of Memphis that's called Midtown, which it is.
Now I thought one of our clients called you on a duplex yesterday, though.
Yeah, and I
You're
will
getting
finish
to that.
there.
Okay, all right.
Right, but we like to think of those as money pits, and we try to avoid those. But now we do from time to time come across duplexes. Where we have some areas where these duplexes were built in the 70s, and
so what you're saying is 3 and 4plexes, no, but duplexes,
no.
Yes.
Yes.
Okay,
and those are pretty much gold. The ones that we're able to get our hands on, they do go fairly quickly, and we on average come across about 2 a month.
Let's talk about another property that you have on our website here
Sure.
at jasonhartman.com. I'm just looking at this one. This is a larger, more expensive property, and that's why I wanted to just share it as a contrast. And I'm looking at the pictures. This is a good-looking home, by the way. One of our markets that just has such good-looking properties is Atlanta. A picture says 1,000 words. It doesn't say every word, but it says 1,000, as the old saying goes, right? So this one is 2,476 square feet. And listeners, don't let your jaw drop when I tell you the price. It's $1,049, so it's only $42 per square foot. It'll only take you just a little less than $29,000 to get into this property, of course, subject to qualifying. In terms of the projections and the way they look, rent at $1,395 per month, so about a 1.4% RV ratio. Cash flow positive at $5,592 per year. So think of this. On $29,000, you're expecting to get back $5,600 per year. I mean, making a cash-on-cash return of a whopping 19%, a cap rate of 10.2%, a debt coverage ratio, which we didn't talk about on the last one, but the debt coverage ratio is sort of the ratio for the very, very conservative investor, and it basically tells you, it answers the question, what are the chances of me ever getting into trouble with this property? And this debt coverage ratio is 2.1, which means you are covering your debt by a factor of 2.1. So you're on a very, very solid position here. Cash-on-cash return at 19% annually, and overall return on investment at 34% annually. And again, we've got the vacancy rates built in at 1 month per year. We've got the management fee built in at 9%. You're not managing. We've got maintenance built in. And keep in mind, this property is not that old. It was built in 1991. Okay, not that old. But we're projecting here maintenance of 5%, which is pretty darn generous for a 1991 property in terms of being conservative. And then real estate appreciation rate projected at only 3%. Now, I've got to just mention something to the listeners about appreciation. See, what we think will happen first, and we're already seeing it to a very substantial extent all over the country, is that we think we will have, before appreciation, we'll have what we call regression to replacement cost. Meaning that if you were to build this house today, it would probably cost you $80 or more per square foot. Well, it's brick, so it probably costs you a lot more than that. You may speak to that. How much per square foot?
Jason, if I were to build this house, and I have built houses like this, if I got my laborers in a headlock and beat them up, I could probably produce this house for a little over $200,000, and that is just really going on a tight budget, $200,000 to reproduce this house.
Yeah. So basically you're buying it for half replacement cost. So before any what we call real appreciation occurs, we're just looking at regressing back to the cost of the materials and the cost of the labor to construct it, not even including really land. So unbelievable opportunities now in the income property world. What else should anybody know about this property or your other target properties?
Well, Jason, one thing to add, again, being in the banking world, I have ownership of a small community bank here in Memphis, serve on the board of directors, and we, in our loan committee, the cutoff on this debt coverage ratio, because that is a huge, you brought that to everyone's attention, but in the banking world universally is 1.25%, meaning that if we're looking at making someone a loan, we're looking at that debt coverage ratio, and if it's below 1.25%, it's pretty much an automatic turn down. And but this, like you said, is at a whopping 2.1, and so 1.25 is sort of that universal target in the lending world. And so, if you told a banker that you had a portfolio of properties with a debt coverage ratio of 1.5%, they probably would call you a liar. It's just a phenomenal number. That's great. You touched on the just the fundamental economic principles of replacement cost, because eventually, something's got to give, not only in Memphis, but, around the United States, in regards to the fundamentals of demand and the cost to reproduce as our population continues to grow, we'll definitely see the market correct itself, and everybody wants to be in the right place at the right time when that happens.
That's for sure, and they can position themselves well by doing these types of properties. Well, what else would you want people to know in closing? By the way, on that debt coverage ratio, in the boom times, the silly times where people were making lots of mistakes and all the dumb money was floating around, right before the crisis, of course, debt coverage ratios were like 0.5.
Right.
so here you're 4 times better, or more than 4 times better than that. But what else would you like people to know in closing?
Well, Jason, we've hit on a good many of the highlights, but probably the one thing that we haven't touched on, which to me is probably is huge, and that's the management piece.
That's the team, and that's what I say to our investors all the time. It's not just about the market;
right.
It's about the team and the network. And there are markets, frankly, that we would like to be in, but we just haven't found good providers there, good local market specialists to do business with, people we can trust, people that we can depend on, people that will keep their promises. That's a very good point. So, what happens during and after the investment with management and so forth? Well,
Jason, I tell you, I did pick up a couple degrees in college, but I did not get a degree in property management, I can assure you. But I've never have not managed my property, so I definitely got my degree through the School of Hard Knocks. And what has evolved today, I have an all-star power team, 6 full-time team members at my property management division. We have invested tens of thousands of dollars in our software. So our owners actually have their own account. They're able to log in to their account at our management company. And so whether they're an investor of ours out of Australia, they're an investor of ours in Singapore, Paris, Los Angeles, Portland, it does not matter as long as you have an internet connection. And it is phenomenal. We have everything that you can imagine. The communication is very automated, and so once an investor does buy a house from us, they're immediately warm handoff to our management team. They have their account set up. Everything is automated from their monthly statements. If there's a maintenance item, a new lease, it just is. I don't know anyone else in the country that has the power of our software and the team behind it. And it is so critical because, again, we see investors who are failing in Memphis, but they're trying to do it on their own. I had a guy from Australia 2 months, is a true story. I mean, he called us. I'm not sure how he found us. He bought a house here in Memphis in a neighborhood we would never go in, bought it on eBay.
Dangerous thing.
He paid $14,000 for it. We helped him get a deadbeat tenant out of there, and I lied to you not, Jason. We had all our contractors go over there, and our best assessment is this house needs to be bulldozed down. It was built probably 1921, and so anyhow, it's a tough business to go at it alone, and all these returns can only happen with a strong team managing the property, and we're in it to our mission. Our mission at the management company is to maximize our owners' cash flow, and we are fighting every day, whether it's a maintenance item or even providing our owners how to appeal the taxes on the property. As values go down, we have a really easy, simple process for an owner to file an appeal online. It takes like 5 minutes, and so any way we can help them, whether it's finding them the best rate on insurance providers, helping them with the tax assessment of the property to lower that cost, because it's all about what? It's all about growing revenue and reducing your expenses. And that's what we are after the sale on trying to help our investors accomplish.
Absolutely. Well, good stuff. Well, hey, thank you so much. I know we've been talking before we finally got a deal together, you and I, for maybe, 6-8 months. It's been a long road, but we're glad to be doing business with you. And again, we were referred by a client of ours, and that's the only way we probably would have gone in here and looked at it. And so I'm glad we found you, and we look forward to doing a lot of business together.
Same here, Jason. We're very excited working with you and your team.
This show is produced by the Hartman Media Company, all rights reserved. For distribution or publication rights and media interviews, please visit www.hartmanmedia.com or email media@hartmanmedia.com. Nothing on this show should be considered specific personal or professional advice. Please consult an appropriate tax, legal, real estate, or business professional for individualized advice. Opinions of guests are their own, and the host is acting on behalf of Platinum Properties Investor Network, Inc. exclusively.